Are you going to get a big tariff refund? How can you save on taxes by juggling around which accounts your funds are in? And how is investing like chess? I'm going to tell you right now. Welcome back to the Personal Finance Club show. Hey, Jen.
Hey, Jeremy. Still that you see that you still haven't painted.
Still haven't painted. Yet a week later, I'm either very lazy or we're recording these episodes back to back. But I think for the next episode you see, if you're listening to this, then you'll just have to use your imagination. But if you're watching, I think you will see I actually have already ordered stuff that's going to go back here to make it into a cool YouTube studio looking thing. My old office was like, I think it was like $1,500 a month or something. And I was only basically going there just to film these episodes, and otherwise I was working from here in my little home office, and it just felt like, too much money to waste and an unnecessary commute. So doing the frugal thing, although the big downside is at the office I had the most beautiful fiber optic internet connection I've ever had, and I sadly canceled it. I called it canceled, and like the guy's like, when do you want to cancel it? And he's like, I was like, I don't know, I'm moving out today. So like today or tomorrow. He's like, okay. Like my phone like went dead right then because he canceled. I was like, didn't I pay through the end of the day? Am I not being prorated? Like you cut me off.
That's hilarious.
I was like, dang, they I don't want, like, everyone hates every internet carrier for good reason, I think, but AT&T kind of had their stuff together on that one.
Well, better that than them saying, no, you can't cancel for 6 months from now. And like,
totally. They're like, oh, you're locked in, right?
Yeah.
No, exactly. I'm like, I don't think they're going to bill me again. I do have to go return their router, but but here in my home, there's no fiber option. So it's just cable. Like it's 2002 or something.
Yeah. We're both pixels now. How does it feel?
Yeah. I know. I used to look clear to Jen because I had like really high upload speed. Now I have slow upload speed.
But you, watcher, are seeing crystal clear videos of Jeremy and I because that's the magic of Riverside and the internet.
We record locally and upload it at some point later.
How yes. Cool. Is that PFC sign, does it light up or is it just hitting the sun?
It lights up. I ordered it.
Has it always lit up? Is it the one from the office?
I don't turn it on usually because it just gets too bright. But yeah, I have this like glow, like actual LED. It's like actually looks really cool on camera. It doesn't really look like much because I think I might try like get some more lights to make the lighting look better. I am a hobbyist photographer, and everything I know about photography is like, it's all about the lighting. It's like what you're looking at and the lighting. That's it. Everyone thinks it's like about settings and it's like literally like stand in front of something interesting and have good lighting, and then that's like what makes for these amazing photos.
Oh, it's the two rules of photography.
Yeah, Personal Photography Club. People always ask me like, "Oh, what camera do you have?" I'm like, "It has." Oh, you think like it's the lighting, not the camera.
Right.
So apologies for my.
I'm excited to see the DIY experience of the office improving.
Yeah, maybe I should do a little time lapse shared on the ground.
You should. I'm going to still be here with my Michael's plant and my green wall. I'm not changing anything, even though Jeremy wants me to, because that's too much work. Also, there's not a lot of space. Like this wall is just right here. I can touch it.
Yeah, no, fair enough. So you have a lot of space in front of you, don't you? I feel like you have a big room.
But listen, it's a small operation here. That's my dining room table right in front of me. Like,
okay,
we can only do so much.
I've been there. I'm lucky to have a whole room.
Yeah.
Well, although I'm sharing my room with my infant son, it's because it's also his.
Oh my God, not the pack and play. I love it.
It's also, he has like an actual crib. We're like kind of in a transition period. We're trying to like get him out. He has an actual crib like in our bedroom. We're trying to get him out of that. So, so now me and Ty are
Father of the Year. We'll make sure to send you a trophy. Okay, let's get into our first segment.
What is it?
Hot topics.
What's the hot topic today?
Okay.
These hot topics sometimes worry me, and this one does too. What's the hot topic?
Oh gosh. Well, Jeremy, like, how are we gonna stay topical? Like everything that's a hot topic is hot.
Good. It's good to talk about, but I'm a Boglehead guy. Bogleheads, we don't care about hot topics. We care about cold topics.
I understand.
Which is buy index funds.
We're speaking for the audience, not for you.
I agree. All right. What's our hot topic, Jen?
Tariffs canceled? Question mark. I have a post here that says, I think it's New York Times, Supreme Court strikes down sweeping tariffs, a major setback for Trump. What is going on? What does this mean? Are
All
tariffs
right,
canceled? Easy
let's
question, right?
let's like do a little history lesson. First, a tariff is
Mm-hmm.
a tax from the U.S. government taxed to Americans, generally American companies, usually sometimes individuals, who import stuff. So you can actually see a tariff yourself if someone in Spain mails you a package and you arrives to the post office. You have to go and pay the tariff at the post office to get the package. Normally, these days, we don't do a lot of that unless you have like friends sending you something directly. Normally,
Mm-hmm.
what happens is you go to Amazon and you buy a phone case, and then whatever company is buying those phone cases from China, when their shipment arrives on a freighter in San Francisco or Boston or wherever these freighters arrive, probably not Boston, it's come from China, but they have to write a check to the U.S. government. And so, you know, Trump has always like portrayed this as, oh, we're taxing foreign governments. Like, no, we're not. You can't do that. They would just say, no, we're not paying your tax.
Mm-hmm. Mm-hmm.
Um, some foreign governments don't like it because, it makes foreign goods more expensive. So if I was to buy a phone case that's made in China, now there's like this tax built in that the consumer pays at the end of the day.
Right.
And so I'm not gonna get it. We've covered this in previous episodes, but yeah,
Mm-hmm.
that's what a tariff is. Okay, normally if you impose a new or greater tax, that's a law and it has to go through Congress. And so
Right.
this whole thing is really weird because there's just like taxes up and down, left, right. You get a tax, you get a tax, you get a tax. These specific types of import taxes called tariffs. And even when this happened, I was like, wait a minute, how can he do that? Like, you can't just make up a new tax whenever you want. Well, Trump claimed he could do it unilaterally, whatever he wanted, based on the 1977 International Emergency Economic Powers Act.
Mm-hmm.
And I'm going to read to you what this act says in short, or I'm going to read
Oh
to you a
boy.
part of it. It says, I know, if you got in your car today saying, I hope someone reads me
An
1977
act.
tax law, you're in luck because
Woo! Buckle
it's
up. I
about to
mean, I
get
hope you're already
crazy.
buckled, but buckle up theoretically for this exciting
Yeah,
law.
if you're not buckled for auto safety, you should buckle up for 1977
Buckle up your
tax code.
mind.
Okay, buckle up your mind. Here we go. So it's only two sentences. Here we go.
Mhm.
After declaring a national emergency related to an unusual and extraordinary threat originating outside the U.S., the president may investigate, regulate, or prohibit foreign exchange transactions, transfers of credits or payments involving foreign interests, importing or exporting currency or securities, regulate or prohibit transactions involving property in which a foreign country or national has an interest. And so basically it's saying, hey, if there's some extraordinary threat out there, the president can act quickly to like regulate transactions, trade, whatever. And, think about in terms of, let's say country X bombs us tomorrow out of the blue and we're selling bombs to country X. You would expect to not sell them any more bombs starting tomorrow, right? And so that's the kind of thing you'd want to act on very quickly without having to pass a law. I think that's kind of like the spirit of this law.
Mm-hmm.
Um, for what it's worth, it never mentions tariffs. It mentions regulate and it mentions imports and exports, but never says the president can create new taxes on imports specifically. It doesn't say that word. And so, this is what's been going on for the preceding year. Trump's been saying, you get a tax, you get a tax, you get a tax. And some of the importers sued the federal government and said, hey, you can't do that. That's not fair. The 1977 Emergency Powers Act says it needs to be unusual and extraordinary threat. Is that true? It doesn't even mention tariffs. Is that true? And so then it went up to the Supreme Court. And I think everyone pretty much thought that the Supreme Court, much of which was handpicked by Trump at this point, would just rubber stamp anything Trump's doing. But that's not what happened. The Supreme Court actually said, no, those taxes that you're levying are illegal. you can't use this 1977 International Emergency Economic Powers Act because it doesn't say you can do that. And so the court, and I'm quoting the New York Times here, says the court in its opinion said that based on two words separated by 16 others in section 1702 A1B of the IEEPA, regulate that's the International Emergency Economic Powers Act, IEEPA. So these two words, regulate and importation, separated by 16 other words, the president asserts the independent power to impose tariffs on imports from any country of any product at any rate for any amount of time. Those words cannot bear such weight. And so that was their ruling. They're saying, hey, dude, this law you said you're really, hoping these two words can let you do anything for any amount of time for any product, yada, yada, yada. Not what it kind of was meant to do, which is if country X is bombing us, don't sell country X bombs anymore. Right. That's what it was meant for.
Right.
So now we're in this kind of awkward situation because President Trump has been not only imposing, but charging tariffs for a year or so. And these American companies who import them have been paying them. And we've collected over $100 billion of tariffs illegally. And my understanding is these tariffs were meant to fill like $1 trillion gap left by reducing taxes largely on the wealthy. And so we're in this very sticky situation where the tariffs are not legal. We have this upcoming now big tax gap. And all those companies who paid the tariffs are saying, wait a minute, I paid you a lot of money. I wrote checks to the government to get my goods in from the shipping crate in the bay. I want my money back. And there's actually more than 2,000 refund-related lawsuits that are currently pending. All these companies now are suing and saying, I want my money back. The New York Times called it a head-spinning process, unparalleled in scale and complexity, to basically unwind all of these now formally paid tariffs. How do you give all the money back to the right people, yada, yada, yada. And to maybe complicate or not complicate things further, the same day that Supreme Court came down with this ruling, Trump said, okay, new tariff, 10% on everybody. And this is not based on a 1977 law. This is based on a 1974 law. And so he's going to even older laws now to, get his tariffs across. And will those be met by lawsuits? Almost certainly, right? So anyway, that's what's happening. It's a mess. We're in the middle of it. Some consumers have asked, wait, do we get refunds? And the answer is no, you don't. You didn't pay the tariff. You might have indirectly paid the tariff because the phone case you bought, which should have been $10, was $14 or whatever. And so is the phone case going to go find, the phone case who maybe is due a refund because it paid the import tax, and maybe you'll get that refund, maybe not, who knows. Are they going to go find all their consumers that paid more prices during a certain window and give them the refund? I highly fucking doubt it. And so, the individual is just going to pay more money and get nothing. And the government and the big companies, maybe get their stuff settled better. I don't know. So yeah, that's a situation. I do think that kind of highlights how tariffs are a regressive tax. Parts of our tax code are progressive, which means the more income you make per year, the higher the rate you pay on all of your income, or at least on the next marginal bracket of income. But tariffs are really a tax on spending. And billionaires spend very little of their money. They can't, because not much stuff costs that much money. If you spend $100 million a year, that's an insane amount of spending for anyone, even a billionaire. But if you have $10 billion, $100 million is what, 1% of that or less? Whereas if you make $50,000 a year, you're probably spending about $50,000 a year. And so these tariffs, indirectly being paid by higher prices to consumers, are getting paid by regular people spending regular amount of money on phone cases and things like that, right? So, not great in my opinion. But what do you do about it? This is a very macro issue. This is being handled in just court cases in the Supreme Court and federal legislators. And personally, you don't do anything about it. you follow the two rules. You spend less, you make more, you do whatever you can. Certainly I wouldn't suggest predicting what's going to happen and making a move based on that. You just have to kind of play the hands that are being dealt to you as they're being dealt. If you're a business, this doesn't really speak great for filling you with confidence about what to expect for the cost of your goods. I have friends who, one of my friends who has that watering can business who it impacted very directly because she ordered cans expecting it to be a certain price, but when they got delivered, this new tariff was implemented. She had to pay that tax, and now the price to consumers has to go up or her profit margin goes down, and she doesn't know the next pallet of cans she orders what the price will be for those because these tariffs are getting in and out over time. So
Yeah.
that's the situation. It's messy. I feel like everyone's so sick of tariffs at this point. We're kind of like, okay, I guess shit costs more when you order overseas, maybe sometimes or maybe not.
Right.
But it is interesting at least that the Trump's largely handpicked Supreme Court ruled against him and kind of was one of the few guardrails on executive power that we've seen in this administration.
Yeah, that's my thought exactly.
Yeah.
I mean, my first thought, honestly, I wonder how many people were like me, was I thought it was kind of a done deal, which tells you how much I'm paying attention to what I'm sure these news articles have been saying all along. But then my second thought was, even if it's not a done deal, the Supreme Court is stacked so heavily in Trump's favor that they'll do what they've done with pretty much every other decision. So I'm surprised.
Wait, what did you think was a done deal? Like these tariffs
The
that he had already...
tariffs, I thought it was just
they were a done deal. Like they're being paid, and now they need to undo the deal because,
I didn't know that was even something that was possible, though.
I don't think anyone knows. I mean, I think I think we're all in this boat, which is like, can you get a refund on a now declared illegal tax? I don't think anyone.
Right.
So I don't think.
And it's like billions of dollars, correct?
Yeah, it's like over $100 billion.
Wild. Okay, well, that was actually a really great explanation. And I know that you hate talking about tariffs, but you are doing the Lord's work by breaking it down like this.
Yeah, check. I guess.
I know that's what you woke up as a goal.
The Lord's like, I have much more important work than this to be doing.
Facts. Okay. Well, great job. I appreciate you, and I'm sure our audience does as well. Let's move on to our next segment. Money. Can I ask a dumb one?
You're asking smart questions to a dumb dude. What's the question today?
Dumb dude. Love it. Okay, we got a question from Mike. He asks 2 questions. 1, which index funds are a better fit for a Roth IRA and which are better fit for a taxable brokerage account? And 2, I know they're more or less equal, but for total returns, is it better/smarter to invest in a total market index fund like FZROX or an S&P 500 index fund like FXAIX?
Mike, bro,
you
got to go back. You got to go listen to episode 21. Because in episode 21, I show the chart and their lines are right on top of each other. So the answer to your question, I'm going to be brief because you got to go back, listen to episode 21, go to the Jeremy Had Time Today segment because I just break it down. I break down almost exactly what you're talking about, FZRX versus FXAIX. And, there's very, very nuanced differences, but they're exactly the same. So the answer is it doesn't matter. Just pick one and roll with it. That said, I think what you might actually be wondering is something slightly different, which is a topic called tax efficient fund placement. The 2 funds you mentioned are identical, so it doesn't matter. But sometimes you have different funds. For example, you might have a total stock market fund and a total bond market fund. And if you ask that question, hey, which fund should I put in a Roth IRA and which one in a taxable brokerage account? That has a maybe potentially more interesting answer. And what tax efficient fund placement is, it's basically saying, okay, you have your asset allocation, which is I want 50% US stocks, 30% international stocks, and 20% bonds. That's like the pie chart of the things you own. But then which funds you put in which account? Because there are really 3 major buckets or types of buckets. One is a regular old taxable brokerage account. That's money you can put infinite money in and out whenever you want with no restrictions, but you pay tax on the growth and you also pay tax on the dividends. When you sell a fund, you pay tax on the growth and you pay it at the capital gains tax rates, either short-term or long-term. So basically, there's tax rules for the taxable account. Then you have a traditional retirement account. That's like a traditional IRA or 401k. Any contributions you make to those accounts goes in there without paying income tax on it. So for example, if you make $50,000 a year and you put $5,000 into a traditional IRA, the government only taxed you this year as though you made $45,000. Then you pay tax on everything you withdraw when you take it out. And then finally, I know I'm just rifling through these, so if this is all brand new to you, then you're going to have to go back, listen to some other episodes. But just as a recap, the third bucket is the Roth bucket, which is like a Roth IRA or Roth 401k. Money goes in there after tax, so you do pay income tax on it if you put money in there, but then it's never ever taxed again. And each of these three buckets has slightly different tax advantages. And because they have different tax advantages, you might use them differently. And so basically, tax efficient fund placement says, hey, put different funds in different buckets to minimize your total tax. And if you do all that, you could actually realize maybe like, not even 1%, but maybe a little bit less than 1%, like 0.5% of overall gains improvement because you're paying a little bit less in tax. And 0.5% over the decades can be meaningful. And so what it basically says is in traditional accounts, you're going to want to put funds that have high taxable income, notably bonds or REITs. Those are real estate investment trusts or any sort of real estate investment, or actively managed funds if you're investing in any actively managed funds, although you probably know if you're listening to this show. So that's for traditional. For Roth, you put your highest expected growth funds, which can be like small cap funds or aggressive equity funds. And so basically, what I think it was Peter Thiel, the billionaire psycho guy.
Billionaire psycho.
I don't know if he's a psycho. I don't mean to
Jeez.
drag his name through the mud, but whatever he is, he did something very clever, which is he would buy shares, almost worthless shares of like tech companies in their infancy when they're being founded, and put them in his Roth IRA. And then they're never taxed again. And so even though it's like technically under the the income limit because he put like $100 in there or something, it could grow to $1 billion and he has $1 billion tax free. That's like the dream use of a Roth IRA because you don't pay tax on any of that growth. And then finally, the taxable account is like anything that's left over. If we could put everything in the other two buckets, we maybe would, ignoring the 59.5 withdrawal age. But a taxable bucket, you'd put things like broad stock market index funds, ETFs, and long-term individual stocks. And that's kind of traditional wisdom, which is, hey, the high tax or the high income kicking off things like real estate and bonds, put in your tax deferred account like traditional, high growth things, Roth, everything else taxable. That said, when I pull out my spreadsheet and I do the math on this, it doesn't really make that big of a difference. First of all, in your own situation, you'd have to look at, Mike here, he talked about the Roth IRA versus the brokerage account. What are those sizes of those accounts? In the most extreme case, they'd be equal size, right? They'd be 50-50 because that's what it would make the biggest difference. In the other extreme case where it'd make no difference is like if you only had like 1% of your money was in a Roth IRA and 99% of your money was in a brokerage account, it's not going to make a big difference because you just don't have that much of either account to make a difference. And same for this opposite. If it's 99% Roth, 1% brokerage, doesn't make a difference there either because everything's going to be in the Roth. And so, only when you kind of have like equal size accounts and equal size funds does putting these in make any sort of difference. And even so, it just, when I do it, it's like way under 1% of added gain. And when I'm talking about way under 1% of added gain, my mind goes to, okay, what mistakes can I make here that would hurt that? Because maybe I've just introduced complexity. This whole thing was probably not that fun of a segment because it's kind of complex. And maybe I've introduced complexity to my life that hurts my life. Or maybe I've introduced complexity to my investment strategy that will cause me to make a mistake because, I forgot to rebalance, or I put this fund in the wrong place, or I bought the wrong amount of this fund. And so if you just bought a target date fund and put the exact same fund in all three accounts, that would be fine. Or if you put had a 3-fund portfolio and put 3 ETFs in your Roth IRA and 3 ETFs in your 401k. I mean, you can't in your 401k, but the equivalent, and 3 ETFs in your brokerage account, that'd be fine too. And so, Mike, to the question you're asking, FZROX versus FXAIX, just pick one, doesn't matter. If you want me to choose for you, pick FXAIX. And then in terms of the tax efficient fund placement question, if what I just said to you strikes a chord with you and you really like this stuff and you like spreadsheets and you like theory, I didn't even get to the other problem, which is, traditional logic says put bonds and REITs into your traditional bucket, but there's the opposite logic might be true too, which is you actually want, bonds don't grow very much. And so you actually want more money if possible in your tax advantage accounts. So by that logic, bonds should not be in your tax advantage accounts and your stock index fund should be, because then your tax advantage accounts will just grow bigger and have more money being shielded from, or having those tax advantages. And so even that speaks to the real nuance here. Oh my gosh, this is like, Jen, we need to get the nuance. Slide whistle. We need to get the nuance.
I wish I could do that crazy whistle.
Like lawn, what's that thing, the leaf blower that everyone hates, like the gas powered leaf blower. We need the nuance gas powered leaf blower.
Yes, wow, that's pretty good.
Trying to work out here, Jesus. Because it's like, okay, well, what's your tax rate going to be now versus what's it going to be in retirement, and like how long are you going to be doing this, and like there's all this stuff, and it's like if you have a theoretical 0.25% gain, if all that stuff goes perfectly, the theory is going to fall apart by the time reality kicks in, and you're like, oh, actually, my tax rate went down, or whatever,
Right.
So yeah, I don't worry about that myself, really. I just put my funds in my accounts.
I would like to defend Mike because he did ask this question long before we recorded episode 21. But
Mike,
sometimes I go on little side quests and I answer the new questions. I get sidetracked. I tried to mix it up a little bit too. So I just want to defend Mike because he's not here in the chat to defend himself.
I really did lay into Mike, and Mike, all those personal insults about your appearance, I apologize. I said I was going to go after your family. That was way out of line. I don't even,
you didn't have to do all that.
Your family, I'm still thinking cartel stuff because I was in trapped in
below
Puerto
the
Vallarta.
belt. Your own trauma. You can't be bringing that into this session.
Sorry, Mike. But and Jen, you've only been, how long, you've been with Personal Finance Club over a year now. I've been doing this for 6 years, and spoiler alert, you answer the same questions all the fucking time. That's not my whole life. But that's great because, this is a place that's safe for beginners. And I think even the experts need a reminder that simpler is better, simpler
and
means more money.
And there's nuance, it's like everybody's thinking about their own. They're like, okay, I know you said that about Ashley, but what about me and Mike? Is it different for me? And then the answer is no, Mike, it's not. You're not terminally unique, You're just going to do the same stuff that everybody else is doing.
After defending Mike, you just told him that he's not special. Mike, you're special. I know you have the number one most common name for men, but just kidding. Is that even true? I think it's Chris. Maybe it's Mike.
I don't know. Jennifer is definitely, for 80s kids, was way up there.
Jen's and Jess's, I got news for you.
Oh my gosh.
You're gonna have
like 3 in my 3rd grade class.
Same. You're gonna have old lady names in 30 years because they were so popular, they became totally unpopular. And so now everyone named Jen and Jess is like in their 30s and 40s, like advancing through time.
Well, Mike, and your regular name and your regular question, I hope that helped.
Man, you accused me. I didn't even say anything mean about Mike. I just told him to go listen to the episode, and you've been tearing him through dragging him through the dirt.
Mike asked this question like 6 months ago, so hopefully he still listens. He's probably like, they're not going to answer my question.
Mike's like, oh, I'm homeless now. I don't have that problem anymore. I have, my life
Poor
has
Mike's
fallen
on the street.
Completely back when I could invest money. That was great. The tariffs have ruined me. He's one of those 2,000 pending lawsuits trying to get his tariff money back.
He's trying to get his money back.
I was an importer.
Yeah. Oh God, poor Mike. All right. Well, I hope that answered your question, and I hope you're still listening. We'll move on to our next segment. Scroll Patrol.
Scroll Patrol.
Heyo. So I've got a video here that I have sourced from the internet. Ever heard of it? And Jeremy's going to watch it for the first time. You might have to download it.
I got it.
Okay. And we're going to watch it together. He's going to react and grade this video. So why don't you go ahead and click on that and we'll talk about it.
May I ask a question? Because someone did bring this up. Would you get rid of your stocks in these companies?
Oh, that's a tough one.
I know. That's what I thought. I thought it was a good question.
Okay, this is the bottom line. Ugh. I think I'm going to have to. I'm also thinking about transferring all of my stocks and bonds and assets from Goldman and going either to a regional bank or even a Canadian bank. I don't want to hurt Americans, but I think I might go to a regional bank.
Yeah.
I am going to try and walk the walk here, and every day I'm unsubscribing or canceling from something. But yeah,
it gets easy to harder. It was a good question from a listener.
Okay, so context is the caption was, would you get rid of stocks in big tech companies as a part of your economic resistance?
Yeah. That's a good question.
Which we kind of talked about before. I remember one listener had a question that was like, should I not invest in these companies? And you're like, huh.
And so that's Scott Galloway, and I think we've did one Scroll Patrol on him before, and I like him. He's like a thoughtful guy. I think he's, I think people would probably say he leans left, but he's like a 100 millionaire kind of successful business guy, and I think is maybe more of a centrist or something. I don't know. This isn't about politics. It's about finances.
You started it.
I know. I don't know. I'm
checking yourself?
Yelling at myself.
Okay.
So, we personally have different opinions on this. First of all, it sounds like he owns individual stocks. The question for me wouldn't be, would I sell those stocks? The question would be like, would I seek out an ETF or index fund that only has good companies in it? And then we also kind of have different takes. His take is basically like, yeah, I'm going to get rid of those. But he kind of quickly pivots to, I'm going to do business with a regional bank. I'm going to cancel a subscription from a tech giant or whatever it is. And, the answer I always give is, holding an index fund doesn't really do much of anything to help the individual companies in that index fund. Who owns the stock at any given point, Tesla doesn't care about. They probably have a slight, certainly the owners have a slight preference for higher stock prices, but just simply being an owner doesn't continually give them any benefit. The dramatically bigger issue is who you're consuming with, like who you're consuming. And so he said, I'm going to leave Goldman Sachs and use a regional bank. What he meant is like, I'm going to stop giving them my business and start giving my business to another bank. Or he said, I'm going to cancel subscriptions. And so like, if you don't like Meta, not owning Meta stocks, not going to do anything to Meta, but canceling Facebook and Instagram and WhatsApp and the rest of the Meta ecosystem, if everybody does that, that would be dramatically bad for Meta. That would be the end of their business. And so I think a lot of times people think that there's like passively benefiting these huge companies when you're not really. But I think also you're actively benefiting them by using their products and services. And so my answer is always like, don't worry about the index fund. That ain't the problem of the world. Go change your consumer behavior, which is much harder to do, by the way. If you want cigarette companies to go out of business, stop smoking. If you're a smoker, that's hard. If you want big tech to go out of business, stop using big tech. That's hard.
Whoa.
Right? Not because they're,
them fighting words.
Jen's like scrolling her iPhone. What'd you say?
Yeah, bro. I'm not even paying attention.
You're canceling my iPhone? It's like, your iPhone's probably safe for a while. So, first, I always think Scott Galloway tries to be a very reasonable, thoughtful guy. And I think he's largely putting his money where his mouth is. I guess I just want to point out the nuance there. Like, he's mostly talking about how he's going to change his consumer behavior and not how he's going to change his investing behavior. And that's what I think makes the bigger difference. So I give it
what's his score?
A-. It's fine. Okay, whatever.
Okay, not impressed by Mr. Scott.
Stop using Facebook. Good luck.
Are you
we watched
using
this on
Facebook?
Or we used it on Instagram.
Oh, that's right. Same company, huh?
Yeah. It's all
okay. A-, not bad, Scott. Let's go on to our last segment of the episode already. Money. Jeremy had time today.
Or in the comments section, you guys are just constantly taking pot shots at me, personal attacks like we did to Mike earlier. And and this is when I get to defend myself.
Yo, I forget. Like, so I'm in the YouTube comments for this one, and I forget that we have YouTube, which is bad. But like, I was just like, I don't. I have like 4 followers across all platforms, so I don't have to deal with any kind of attention. And sometimes you're just like,
you know where you can go, Jen? You can go to LinkedIn. We get a bunch of LinkedIn comments. You can go to Spotify. We get Spotify. I know some of the Spotify commenters are listening right now because I think Spotify.
I need something interesting. They're all like, "You're so great." Let me not make
the meanest ones are probably on TikTok because TikTok,
they're not
or maybe
that interesting.
LinkedIn. I don't know. All right.
There's a lot of bots on TikTok.
Yeah.
Anywho, so it's just interesting to actually like have people perceiving you online. I'm like, that is weird. I don't know if I'm meant for this. Okay, so I'm in the YouTube comments. We talked about the 4% rule in one episode. Do you want to give a little refresher on what the 4% rule is before I read this comment?
Yeah, it's basically a rule of thumb to kind of quickly assess whether or not you have enough money to retire. And if you look at your total invested assets, across IRA, 401k, etc., you take 4% of that number, you can live on 4% of your invested assets today and even account it for or increase it for inflation going forward indefinitely. So for example, if you have $1 million, 4% of that is $40,000. That means your $1 million invested can be pretty reliably counted on to produce $40,000, even accounting for inflation of annual income going forward for a long period of time.
Nice.
And this commenter said,
you left out a key component of the 4% rule, asset allocation. The 4% rule doesn't work if you have 100% of your money in tips, TIPS. You also left out the time horizon of a 30-year retirement. A 45-year-old retiring with maybe 40 to 50 years to live would have a low probability of not running out of money.
Yeah, this is like in my one of my least favorite types of comments. I guess insurance salesmen are my least favorite comments, but this is the like, well, what about, or you forgot, you left out this comment,
right?
And the answer, like, of course that's true because every piece of content you're commenting on exists in a vacuum according to you, and this isn't the 30-page study. This is me just briefly mentioning the topic or whatever,
right?
And it wasn't even the comment wasn't even fully in good faith because he says a 4% rule doesn't work if you have 100% of your money in tips. Tips is Treasury inflation protected securities. It's basically like one of the safest bets in investing, which is just keep your money in cash and increase it for inflation and nothing else. And so, of course, the 4% rule doesn't work there because there's no growth. It just matches inflation, doesn't grow 4% beyond inflation. And I think that was kind of like a tongue-in-cheek example saying if you have like the most conservative portfolio I can imagine, it wouldn't work. He could have said it wouldn't work if you have 100% of your money in a checking account for the same reason, right?
Right.
By the way, I'm being too mean to the commenter. Everything he's saying is right, by the way. Like,
how do you know it's a he?
I mean, come on.
Come on.
If
girls can be mean too and wrong.
Not like this though. They're not mean and wrong like this.
Okay, sorry, continue.
Do you know the gender of this commenter?
I don't. No,
I do. I looked it up earlier. It's definitely a dude.
Did you look it up? You be in the comments, yo.
Well, because you had a link right above it because I had to go refresh myself on what was said.
Take it easy.
I'd be in the comments. And this video had a ton of comments. I think it had 2. We're getting really popular now. Let's see. What is this commenter's
name? YouTube needs help. Guys, go to our YouTube, please.
Howard Friedman. I'm pretty sure Howard's a male's name.
Why are you doing that?
It's public. He posted it. You're the one that didn't want to dox people.
You don't know any female Howards?
I don't know. I don't want to assume the gender. Howard, could be
All
trans.
right, so he said he's right, is what you're saying.
So yeah, everything he's saying is basically right. And the Trinity study really does kind of cap its look at 30 years. If you're going beyond that to 40, 45 years, 4% might be slightly too aggressive. You might want to do 3.5%, something like that. Right. And for more generally, there's no guarantees, right? this type of overly surgical dissection of the 4% rule just like doesn't hit home with me, because he's like, well, what about a 50-year retirement? This is my impression of me in 50 years. I'm 95. Oh, I just ran out of money because 50 years ago, I set my flag in the ground and said, I will spend $72,300 each and every year from this day until the end of days. And if it's not going to run out because of the 4% rule and I'm never going to adjust anything, I'm never going to react, I'm never going to change. And now I've run out of money in my 92nd year. I've made a critical mistake 45 years ago. Like that's not how real life works. The point of the 4% rule isn't to have like a perfect projection to the future and never ever change anything. It's to get a general sense. Am I close? Am I not? If you need 3.9% of your investable assets to barely cover your living expenses right now, yeah, you're probably not quite there yet. You probably want to get a little bigger buffer. If you can live very comfortably on 2%, yeah, you should probably be quitting your job and using your time now to do exactly what you love. If that's working, keep working, but you probably don't need to be, right?
Right.
And if you, by the way, if you're like right there at the 4% rule, you quit your job, and then 3 years later, you have the worst 3 years of the market in history and you lose your home and blah, 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 like you might want to like rejigger things a little bit, not just die on that hill you set your flag in because you're going to spend 4% of this because that was the decision you made 50 years ago. And so, I think people who like are too concerned about this 4% rule are people who are constantly looking at their numbers, but don't take into account the fact that they will continue to constantly look at the numbers and, reassess and reevaluate as time goes on. So I still like the 4% rule because it gives you a really clear way to understand, hey, am I in the ballpark or not?
Right.
Without it replacing like a super complex 50-year, bulletproof plan, because there's no such thing as a 50-year bulletproof plan. No one knows what's going to happen.
Yeah, you don't just want to be going off vibes, but you can also be somewhat flexible when it comes to the rest of your life.
Yeah.
All right.
Sorry, I was mean to you, Howard.
And you're saying their name again. Okay, great.
Like he's in the witness protection program. He's commenting public comments on YouTube videos with his name. Maybe he already put a pseudonym. If you don't want your name to be public, don't go commenting on a hugely popular video that has, let me check. Let me see, 634 views.
Yeah, that's not bad. That's not bad.
That's
considering the rest of our YouTube history.
Hey, we have some in the millions. Okay, it's a.
I think that was before me.
the Halloween costumes always do very well.
I've tanked the PFC YouTube following.
I mean, we're posting different types of content, but it's a deeper audience. The people hearing my voice now have a deeper audience. But yeah, 600, and you're right, 634. If 634 people walked into my house right now, I would say there are a lot of people here.
Get the hell out.
This is a
You fit 634 people in your house?
I mean, it would not be safe.
Yeah.
That'd be
against
sure.
fire code. Okay, well, thank you,
It's
Howard.
like a frat party or something,
you didn't
right?
opt into being roasted on the pod, but you're probably not listening. But thank you.
I mean, if anyone's listening, it's someone who comments on our YouTube.
Yeah, that's true.
But like Howard. Everything you said was right. But my whole point is like, we don't. And I think I might forgot to mention, like, yeah, the 4% rule itself relies on a 75% stock, 25% bond portfolio. And so to Howard's point, you're totally right. If you have a crazy portfolio, like 100% tips, that wouldn't make sense. But at the end of the day, we're just kind of going for best practices. I have a really good analogy. I just thought of it. Maybe it's a terrible analogy.
Let's hear it.
In playing chess, if you thought reading 1970, was that this episode? It was, wasn't it?
It Tariffs.
Was. If you thought reading 1977 tax code is boring, wait till I give you a chess analogy. In playing chess, I think what a lot of amateur chess players think you're supposed to do is think 30 moves ahead and analyze every single position and figure out what's going to go on. But Magnus Carlsen, arguably the greatest chess player in history and unarguably the greatest chess player of our time, says he rarely looks many moves in advance unless it's like a very, very simple situation where there's only so many things that can happen. He's usually looking only, a couple moves, 2 or 3 or 4. And what he's really doing is just using best practices. So instead of saying, if this happens and this happens, this happens and this happens 18 moves down, he says, I don't want to move my queen out too early because that can get me into trouble. I don't want to have my rook against the edge because then the rook, or I don't want to have my knight against the edge because then the knight has fewer places to move. And so you're just using a lot of like best practices, saying, hey, these are the types of positions that are going to put me in a better situation, not I've guaranteed this is going to work 50 moves from now. That's what like the world champion of chess is doing. If the world champion of chess can go on heuristics and positions, I think personal finance enthusiasts can do the same thing. We're not saying, hey, invest in these exact things because this is going to guarantee to work 50 years from now. Say, hey, we want to spend less money. We want to take advantage of tax advantage accounts. We want to live on around 4% of our income or less, if 4% of our net or investments or less if we can. That's the kinds of moves that we're making that are going to result in long-term success. Because, like Magnus said, I don't look 18 moves in advance because 3 moves later, you're in a different situation. Same for this. 3 years later, we're in a different situation. And you're putting yourself in generally good moves, saying, hey, I'm going to not live on dramatically more than 4% of my investments, which is fine. And I think people say, okay, what if I do exactly 4% and then it fails? Like, well, you might need to, reassess a little bit, but you're probably going to be fine.
Okay, and if you're like me, the definition of heuristic, involving or enabling discovery or problem solving through methods such as experimentation, evaluation, and trial and error.
Oh.
Do you remember even saying that?
I would just call it like a rule of thumb, like, I think that definition was more confusing than what I meant for it to be. But yeah, it just means like a rule of thumb. Like
the
a general...
second one is, proceeding to a solution by trial and error or by rules that are only loosely defined.
Yeah.
Does that make more sense?
Yeah. So you're saying, hey, generally speaking, you would want to live below your means. Generally speaking, 4% means you're on pace for an early retirement. Things like that without, sometimes I revert to engineering speak.
Yeah, I'm fighting for my life over here.
All right. Anyway, thanks, Howard. You're totally right. Everything you're saying is correct, but I think I take a little bit more of a relaxed approach towards these types of things because we're not trying to think 18 moves ahead. We're trying to just make good moves right now.
Be like Magnus Carlsen. And on that note, give us the rules.
I'm so glad we got chess involved. I play chess almost every day, and I'm really not good at all.
Online?
I play on my phone or on the computer, just like when I need like a mental break. But the problem is I don't like practice or try very hard. And so I just basically, if I don't blunder my queen, that's like a great game for me. Guess my ELO in the comments, please. If you listen this far and you know chess and you guess my ELO, and
what
how
are
about
the
this,
words
Jen?
that you're saying?
If you guess my ELO correctly, or whoever guesses it the closest across Spotify or YouTube comments, you're going to win a free PFC course. We'll email it to you.
They all have it, Jeremy. They're listening.
ELO is the rating you get. Stands for something I don't even know what, but every chess player like has a rating of how good they are. Essentially,
we're living in different worlds. You and I.
All right. But if you do want to build wealth, you can follow these 2 heuristics. Heuristic number 1, live below your means. And heuristic number 2, invest early and often. See you next time.
The Personal Finance Club show is produced by Jeremy Schneider and Jen Mundia. Music by Esabalu and Homie. Send your questions to podcast@personalfinanceclub.com. The Personal Finance Club show is co-hosted by Jeremy Schneider, who is a co-owner of Nectarine, an SEC-registered investment advisor. The views expressed on this show are those of the hosts and guests and do not necessarily reflect the views of Nectarine. Please refer to hellonectarine.com for all relevant disclosures. This podcast is for informational and educational purposes only and should not be construed as personalized investment advice or a solicitation to buy or sell any security. Listeners should consult their own financial, legal, or tax professionals for advice specific to their situation.